Welcome to The Explainer. So today, we're diving into a really interesting one, Richtech Robotics. This company is right at the heart of a huge, high-stakes bet on the future of AI and robotics. Is it the next big thing, or is it all just hype? Let's get into it.
Okay, so first things first. It all starts with the size of the prize. And honestly, it's massive. We're talking about the market for service robots, the ones working in hotels, hospitals, warehouses. It's projected to be worth over $200 billion. That isn't just growth. That's an absolute explosion waiting to happen.
And to put that into perspective for you, we're looking at this market more than tripling in just the next decade. Now, what's driving this? Well, it's pretty clear. We've got persistent labor shortages and, at the same time, these incredible leaps forward in artificial intelligence. This is the powerful wave that Richtech Robotics is hoping to catch. So, the big question is, how is Richtech planning to grab a piece of this giant pie? Well, they've got a whole lineup of robots, everything from automated bartenders to heavy-duty industrial machines. But the real story here, the thing that makes or breaks this entire investment, is their huge, high-stakes pivot to a totally new business model. See, they're moving away from just selling a machine one time. Instead, they're shifting to a subscription model. It's called Robotics as a Service, or RaaS for short. Now, if you're an investor, this should sound familiar. It's a lot like a software company, right? It's a complete game changer because it creates this steady, predictable, recurring revenue stream. And that is something the market absolutely loves to reward with higher valuations.
And this, right here, is the heart of it all. The potential outcomes are just incredibly different. I mean, look at this. If Richtech nails this transition to RaaS and gets over 1,200 robots out there, the bull case is looking at over $10 a share. But if they stumble, if they fail to scale and get less than 500 installations, the bear case sees the stock completely collapsing to under $3. It's a classic high-stakes bet that comes down to one simple thing: execution.
Okay, so let's dig into that really exciting bull case. What exactly needs to go right for investors to see that massive upside? What does that path to $10 actually look like?
For the bulls, the path forward has three really clear milestones. First, they have to absolutely nail that RaaS pivot. I'm talking turning small pilot programs into huge, company-wide enterprise deals. Second, they need to hit a critical mass, getting over 1,000 robots out in the real world by 2026. And third, and this is crucial, they have to prove that their AI, which is powered by a key partnership with Nvidia, is a true game changer that puts them way ahead of the competition.
And this is where their tech edge could really shine. Through their partnership with Nvidia, Richtech uses something called a sim-to-real pipeline. Basically, they can train their robots in a virtual world, kind of like a video game, running millions of simulations before a single physical robot is even built. For customers, this means they get their robots faster, cheaper, and with less risk. For Richtech, this could be their secret weapon against competitors.
Now, here's where that RaaS model gets really exciting for the bulls. A 74.4% gross margin, that's incredibly healthy. It means that as they get more subscribers, a huge chunk of every new dollar drops straight to the bottom line after they cover their initial costs. That's the operational leverage investors are betting on, the potential for absolutely explosive profitability down the line.
But you knew there was a but, right? Of course, there's another side to this story. As exciting as that $10 path sounds, it is loaded with some pretty big hurdles, which the bears are very, very quick to point out.
The first and maybe biggest hurdle is the valuation. Richtech's price-to-book ratio, which basically compares its stock price to the actual value of its assets, is way, way higher than its peers. What this means is the market is already pricing this stock for perfection. There's just no room for error. Any little slip-up or delay could get punished, and punished severely. The next big red flag is their cash burn. The company is spending money a lot faster than it's making it. And to make matters worse, revenue growth has stalled out recently. So to keep the lights on, they have to issue more stock. And every time they do that, they dilute the ownership of existing shareholders, making your slice of the pie just a little bit smaller.
And finally, there's this cloud of uncertainty just hanging over the company. A short seller report came out with some pretty serious allegations of fraud. Now, it is absolutely critical to say that these are unverified allegations, but true or not, just the headline risk alone can be enough to scare away the big institutional investors, the kind of money you need to keep a stock stable. So let's pull all of this together and get to the final verdict. This is the exact dilemma that any investor looking at Richtech is facing right now.
When you look at the professional analysts, well, they're completely split. The most optimistic ones see a lot of upside from here, targeting over $6 a share. But the most pessimistic analysts, They see the stock losing almost half its value, down to $2.50. The consensus is smack in the middle, which just goes to show how much uncertainty there really is here.
And that brings us all the way back to the main question. On one side, you've got a potential leader in a massive, world-changing industry. On the other, you have the really harsh realities of burning cash, a sky-high valuation, and huge execution risk. So which is it? Is Richtech a revolutionary AI leader or a speculative bet? The story is still being written, and it's going to be a fascinating one to watch. The final call, as always, is yours.